Hello guys, welcome to another video. If you want to know how to use a technical analysis concept called divergence to catch a large down move like this one here on the chart, then stick with me. I'm going to show you how to do that right here in this video. So we're going to focus on a specific type of divergence that you'll often hear referred to as SMT divergence, which stands for smart money technique. This is the name given to it recently by ICT, or the Inner Circle Trader. But like many trading concepts, it's been around for much longer than ICT has. The earliest example of this concept that I'm aware of is Richard Wyckoff's comparative strength analysis, if you want to look that up. But who knows if he was even the first to use it? And really, who cares? The important thing is that if you compare two assets that are usually correlated to each other, or in other words, normally move in the same way, and then you see suddenly that they're not, then you have a divergence. And this is what the definition of a divergence is: a situation where two things that were the same suddenly become different, or the difference between them increases. In this video, I'm going to explain why you need to understand what divergences are, how to find them, and how they can be a benefit to your trading. If you're second guessing yourself on whether a trade is about to go in the direction your other analysis tells you, I'm going to show you some ways that you can get an extra indication on whether you're right or wrong using SMT divergence. To look for SMT divergence, we first need to identify some examples of assets that usually move in the same way. So now that we've got some assets to compare, let's hop on a chart and find some divergence. Okay, so here we are on the chart. I've already drawn some stuff out for these examples, so let's go through what we have here. So the first thing I want to point out to you is that we have the NASDAQ up here and the S&P 500 down on the bottom left here. And then we have the two 1 hour charts of those two. And then on the right side of the charts, we have at the top the NASDAQ 5 minute and the S&P 5 minute. So what we're going to do is we're going to look for divergence on the 1 hour. So between these two 1 hour charts, and then we're going to go down and refine it a little bit by looking at what's going on the 5 minute versions. Okay. So here we can see a large 1 hour fair value gap on both the NASDAQ and the S&P 500. Now, the first thing you might notice is that price on the NASDAQ goes up into this fair value gap and actually comes to the 50% of consequent encroachment and then gets rejected. Whereas on the S&P 500, price can't go up into the same fair value gap, and it's exactly the same candles, okay, that are involved in creating this. So you can see that one of them, the NASDAQ, has taken liquidity in this fair value gap. And you can see here on the S&P 500 that it's failed to take the liquidity. So that alone is a divergence. Because if we draw a line, I haven't drawn this on, but I can do. We draw a line here, and then we do the same thing from the same candle on the S&P and the same candle, which is that one, I believe. You can see that the the NASDAQ has an upsloping line and the S&P has a downsloping line. And that's because this high here on the S&P, the highs that came up failed to take that high, right? Whereas on the NASDAQ, price did take the high. Okay? So you can see, again, a divergence. So you can have divergence at highs and lows, but you can also have divergence within points of interest. So when one asset has taken a point of interest and another one hasn't, that's also a divergence. So given that there's so many divergences here, this gives us quite a strong idea that when price comes back up to visit this on the NASDAQ and it doesn't on the S&P, that we may now have a pretty good trade coming out of this area, because we also have the divergence on the highs. Okay? So that's a double divergence, if you like. Now, what we can also see if we zoom just a little bit more, I'll do that on both, is that we can see there is also a divergence on the highs inside the fair value gap. Here we have a high and then we have a lower high. Okay, and I've drawn a green line there. Let me just zoom a little bit more so you can see a bit better. The green line shows the two highs, and the same two highs on the S&P, you can see that this one's actually made a higher high. So another divergence is occurring here, okay? And that divergence on the NASDAQ is occurring inside a 1 hour point of interest. after a further divergence from this area here. So there's now 3 lots of divergence between these 2 highs, and the fact that we've taken this fair value gap and we haven't taken this one. Okay? So what can we do? Well, the first thing we could consider is that after the divergence has happened, we now want to see some sort of confirmation that this is actually turning into some kind of down move. Okay? Now we have the rejection at the point of interest, which is great. We have the 2 divergences. Now we want to have something else, and we could use, for example, a change in the state of delivery. So if you just wanted to trade the 1 hour chart, you could draw a change in the state of delivery right here. And then as you can see, when price comes down and breaks through it, it revisits and then price drops. Okay? So you could potentially get a trade out of there. Okay, and you'd have your stop above the highs here, okay, and then you'd get quite a nice trade. Anyway, that's one way you could do it, right? You could trade it just on the 1 hour chart after seeing all this divergence. But of course, what we can also do is drop down to other timeframes, smaller timeframes, and refine it a little bit. But let's just focus on this one for now, because there's also another entry here, right? There's an entry here from a bearish fair value gap on the 1 hour, which gets tagged back in and goes down. There's also a potential entry here from this inverse fair value gap, which I can draw that out so you can see it. I don't want to focus too much on the entries, but it's important, I guess, as part of a strategy, if you wanted to use this as a strategy, that you see that after the divergence, you want to see something else. You don't just want to trade blindly off this divergent, because sometimes what you'll find is that price will show a divergence and then it'll either be a false one, or it will show another one right after it and another one right after it, and it will be chopping around all over the place, showing random divergences. So you need to have them in line with other stuff, okay? So we've got multiple ways to enter on this 1 hour chart. Let's have a quick look over on the 5-minute chart then. So what do we get on the 5-minute chart? So on the 5-minute chart, you can see that we have the 5-minute divergence, which is basically this divergence occurs here roughly. Okay, it's the 1 hour divergence on the 5-minute. So again, we've got this divergence happening inside of the fair value gap. If we wanted to take after the divergence has occurred, after the green line is the 1 hour divergence, okay? After that divergence has occurred, what we could do is we can just wait on the 5-minute chart for a change in the state of delivery, for example, which we get after closing below these candles here. Okay, and you can see we come up multiple times to tag back in, stop loss above the high, and down we go for what we got there. I don't know what I've drawn out, 5 to 1, but I didn't necessarily say you should take a 5 to 1, although if that's in your risk parameters, do it. But you can see how we can then refine further on the 5-minute chart by using these 1 hour points of interest and the divergence to then come down onto the 5-minute and refine further. Okay, and what you can see going down here is there is multiple entries possible down here, but I don't want to go into them all. If you want to study this, it's 9th of April 2025 roughly. You can go back and take a look at all this. I don't want to go into too many entries because it's just going to get too much for the video. Let's move on to the next example. Okay, so example number 2 then. Again, we have a 1 hour bearish fair value gap. We're back on the 25th of March 2025 now. And you can see on the chart that I've actually marked out a strong high here from previous videos. We'll just leave, I'll get rid of it. There we go. Take it away so we can see better. So what do we have here? We have price coming up, making higher highs here. But what do we have here? The exact same candles on the S&P 500 in a down move, okay, making a lower high. So that gives us a divergence. What we can then do is, again, we can mark out all our change in state of deliveries, you know, our internal structure, okay? And we can see what price is doing. So we've got some mostly bearish action with one bullish example in here. Obviously, it's majority bearish. So after this SMT, we have the majority bearish internal structure, okay? So if we're looking after the SMT, then what we also have here, you can see on the NASDAQ on the 1 hour, is we have a 1 hour change in the state of delivery. Okay, on this candle here, where I've drawn a blue line, you can see that, or a vertical blue line there. So if you wanted to wait for the 1 hour version of this, what you'd need to do is, of course, let a close happen below the up close candles. Okay. Now on the Nasdaq, if you traded that particular 1 hour change in state delivery there, you wouldn't have got tagged in. Whereas here on the S&P 500, you actually would have done. You can see here it breaks, comes back up later to retest, and immediately gets rejected from there. Because you can see that the Nasdaq has made a much deeper mitigation of this fair value gap, but the S&P hasn't done that yet in this part here. Right, this has gone all the way through its fair value gap. This one has only got to just over halfway. Which one's stronger or weaker? Okay, if you're going to trade one, which one should you trade? I would never base that on SMT, because let me tell you why. If you look at it from a liquidity perspective, then this Nasdaq has come up, it's taken all the liquidity in that fair value gap. It's also swept its own highs, right? It's swept this high there by going up to here. So it's succeeded in taking liquidity and then getting the fuel for the move. But equally, the S&P 500 has failed, but it has taken liquidity, but then it's failed to make a new high, which is the SMT that we're seeing on the screen. So then it's showing failure and weakness. So what's strongest? Taking liquidity and then moving down, or failing to take a new high and failing to take all the liquidity and then moving down? I mean, is failure stronger or weaker than taking liquidity? I don't have an answer for that, because that is not the criteria that you should be assessing, in my opinion, when you're looking at SMT. When you're looking at SMT, you need to have a look at the overall picture of things and how things are playing out. So if we track our internal structure, for example, we've already talked about this taking lots of liquidity from the whole fair value gap, which is nice. I like that. And then we come down, and the move down, you can see this very, very small break to make a bullish change in state delivery. Whereas here, look at the break above here. It's much stronger, right? So it's pushing up harder here. So I'd say that this one's showing the most weakness in terms of wanting to go down, and it's taken the liquidity already. Okay, but the internal structure is telling me that this is the most likely to go down. Okay, that doesn't mean you can't take either, because it honestly doesn't really matter that much. Sometimes it will be one, sometimes it will be the other, but a lot of the times it will just be both, because both of them have the same move coming. That's the theory, right? They're supposed to move in the same way. The fact that they're diverging means they haven't temporarily, but they're supposed to be moving in the same way. So we expect that, it's going to go back to moving in the same way after a divergence at some point, right? So we're saying that they're both going down then, based on all this structure and everything. So, I mean, there's multiple. If you didn't get this entry, you could have got this entry, right? You could have entered here. You could have entered, multiple places on the 1 hour. And the same here, really. Let's see. I mean, you go above these highs, right? So you could have entered most of these. I don't want to go through all of them. But here on the 5 minute, I mean, again, what do? We can enter here, right? We've got after the divergence, we see when's a break of structure, or sorry, a change in state delivery. That happens here. Enter there, job done. So, I mean, that's also in confluence with the 1 hour change in the state of delivery. But here, look, you've got a 5 minute change in the state of delivery that's in line with the 50% of the fair value gap and the 1 hour change in state of delivery. So you could either enter on this here, and you get a close below on this candle here, I think, and then you get tagged back in and go. There's a lot of potential entries here. If you came down to this area, it starts to consolidate a bit. You could have got entries from here as well. I don't want to, again, go through these. Change in state deliveries are quite large, so I probably would have taken the 50% of some of these, like this one here, for example. I prefer mine to be a little bit more refined. This one's okay, but this one's getting a little bit larger. So, it's up to you. I mean, if you'd entered here and you put your stop loss above there, you might have got a decent trade, but you perhaps might have got stopped out up here. But then again, you can enter here and you'd get, a decent trade. You can enter here. And so, yes, sometimes you're probably going to get stopped out. Okay. Does that happen on the Nasdaq as well? Yeah, they're pretty similar, I think, in terms of highs and lows. So, yeah, what you do see actually on the Nasdaq, though, that's interesting. Sorry, on the S&P, down the bottom here, is that there's a nice 5 minute fair value gap, and that provides good confluence for trades coming out of too. So sometimes you've got to have a look at what else is above the area you're trading, what's on the, what other points of interest are there to consider, okay, there's a fair value gap above these change in state deliveries. Do I want to take a trade there? But you can see that I've drawn on a few trades you could have taken, and this one even worked. They're all over the place. You could get a decent trade out of any of this. All right, next example. Okay, example number 3, again, 1 hour charts. So we have, let's see, we've got a small divergence here. I mean, it's a 1 hour divergence. What you've got to think about is that when you see a small divergence like this, when you see it on the 5 minute, if we come over to the 5 minute, you can see where the 1 hour is drawn. And now, of course, it would be linked to these highs, but it doesn't do that when you draw it on the 1 hour because it does it on certain candles, right? But you can refine it, to here, whatever. Okay. But you can see that this mini divergence, this microstructure on the 1 hour, is actually, a decent amount of structure on the 5 minute. Let's zoom into the S&P as well to get that. We can dial that in a bit better as well. Do that. You can see I'm trying to use the same candles here. Well, I missed it completely there, didn't I? And trying to use the same candles. So there. Okay, you can see there's a down and an up. So there's a divergence, right? You can see them compared there. So microstructure divergences on the 1 hour is going to be a full, range of divergence, range of price on the 5 minute. We probably know that from our prices fractal videos and stuff like that, right? All right, so this one is 1 hour inverted fair value gaps. Okay, what we can see is, let me just zoom out a little bit so you can get a better overview of this. What you can see is where the NASDAQ came down and then came back into both of these fair value gaps, or sorry, inverse fair value gaps. What did the S&P do? It didn't manage to get there, right? And the S&P didn't manage to get into either of the inverse fair value gaps like the NASDAQ did. Now we can also see here that at the point where price goes into the fair value gap, or the inverse fair value gap on the NASDAQ, on the S&P, it fails to get inside there, and it also has a divergence because it makes a higher low, a lower high, and this one makes a higher high, as we can see. So there's another divergence, right? There's a divergence coming out, creating all this. There's another divergence after NASDAQ has tagged into the inverse fair value gaps. So you can see that NASDAQ comes into it twice, S&P fails twice. Okay, so how do we get something out of this? Well, again, it's do you want to do it on the 1 hour and stick to that, or do you want to do it on the 5 minute? Doesn't matter. Okay, I've drawn out a few change in the state of deliveries on the 1 hour here. I haven't drawn all of them. You can see there's one here and stuff, but again, you could have got trade out of that, I guess. There's also 1 hour fair value gap there, which I don't think. Oh yeah, it is on the S&P as well. Okay, and you can see again, look, we've got another divergence, right? S&P doesn't get into that fair value gap. NASDAQ does. So, is there points where you can take trades here? Here's the divergence inside the fair value gap, the inverse fair value gap there. So now if we go down to the 5 minute, on the NASDAQ, we have a 5 minute change in the state of delivery, that line, red line, and then you've got the 5 minute bearish fair value gap, okay? So we come back into all of that, and then we want to refine it even more. We say, okay, once we get back into this 5 minute fair value, change in state delivery and fair value gap, we then look for another 5 minute change in state delivery, which we get here. Okay, price comes down, tags you back in, and down it goes. I won't even show you, it's way down. Okay, so again, you can execute whatever trading models you want within these. I'm just giving you some examples using fair value gaps and change in state deliveries because that's something we've already covered and should be familiar with. You can do this how you want. You can trade on the one hour, you can trade on the 5 minute, you can do the 1 minute, 4 hour, whatever it is you're trying to do. Doesn't matter. We know how to mix time frames now. I'm not going to go into that anymore here. One more example. Okay, so this example is going to be just considering mainly market structure for the point of interest. So we can see that on the S&P 1 hour chart, we're coming down in a downtrend. Okay, this is out of the previous example we looked at earlier. And I marked out a strong high there, and we've got breaks of structure and all this stuff, right? So we're coming down, lower high, lower high, lower low, lower high, lower low, lower high, lower low. but we don't actually break above this strong high at this point. We only wick it. It's hard to see because I've drawn the line on, but we only get a wick above there. Okay? And then we get a failure to make a new low. So what does that tell us? Well, it tells us a couple of things, right? We failed to make this high, or break the high. We also failed to take the low. So my thinking is that, well, firstly, we're going to take the low, okay? Because everything's becoming weak in here now. And we're also going to take probably this high now, because we've tried to push above one time, and we only wicked above. And then we failed to put in a new low, which we should have done if we were continuing down, right? We came back up for another failure, came back down, took out these lows. Then we've started to move up. You can see the structure change, right? We've got lower high, lower low, lower high, lower low, higher high, higher low. Okay? So there is our reversal pattern, right? And especially when we break past this 1 hour strong structure here with a breaker structure, you can see in there. So we've got a breaker structure here, right? What do we get just before that breaker structure? We have, on the NASDAQ, we've got higher low there. On the S&P, we've got a lower low. So we've got divergence. Okay? So at the point where we pull back after the breaker structure, we pull back into the zone here, and then we continue up, we start our uptrend, we've got a divergence. So zooming into the S&P then, what have we got? Look, we've got bearish structure, right? Breaks below these up close candles. And then we start to get breaks above the bearish candles, signifying what? That we're either in a range, which we are there actually, or when we get all these breaks, we're starting to go up. Let's have a look on the 5 minute, see if we can get something out of this. So on the 5 minute then, we can see that if we look at the blue line here, this is when we get our first opportunity to get in after this first change in the state of delivery here. So anywhere on this blue line or after. If we just look after the blue line for a bullish change in state of delivery on the 5 minute chart, we are seeing that we've wicked the 1 hour change in state of delivery, right? Okay, you could have taken a trade out of that. But let's take the first opportunity after we've wicked that, because now we're showing support from that. So here, if we enter on the 5 minute, you can see the price comes above, taps us back in many, many times, and then goes up. But if you missed that, you've got other opportunities in here, for example, and in here is another version. Look, it's another way you could have entered there. Price comes up, breaks above, taps back in, off we go. Okay, and there's more change in state deliveries going upwards. Clearly, we're bullish now for the time being, and then we have a little pullback and then another expansion. Okay, so again, you know, after this, where are we? After these SMTs, there's plenty of chances now to look for bullish signs and to enter on either the 1 hour if you want to, because I believe that it gets tagged in on the 1 hour there. Yes, it does, because we looked earlier, didn't we? We break above, we tag back in on this candle, there's the 1 hour version, and off we go. Or we do it on the 5 minute, just refined a little bit and take it there. Doesn't matter. It's whatever you want to do. Okay, so we've been looking at divergences of assets that normally move the same, but then suddenly start to move differently. But there's also assets that don't normally move the same, but then suddenly start to for a short period. This means that basically they're usually moving opposite to each other rather than together, like the examples we've already looked at so far. So when two of these assets that normally move opposite start moving in the same direction, we have an SMT again. Let's take a look. So a great example is US dollar versus the euro index, right? What you expect is that when one of them gets stronger, the other one's going to get weaker. Now, this can be a little bit more difficult to get your head around. So take a look at this video here of mountains being reflected in a lake. They're exactly the opposite image of each other. And if we draw a line down the center of the screen, we can see that when one mountain becomes higher above the line, the reflection of the mountain becomes below the line becomes an equal amount lower, right? So they move away from each other. And when the mountain becomes lower, the images start to move closer towards each other. Now, if we apply that to the chart, if we look at this line, you know, these lines separating the two, if we imagine this white line, right, is separating the euro and the dollar, what we expect is that when the dollar rises in price, like here, it's moving away from the white line, right? It's moving upwards away. So what should the mirror image of the euro do? The euro should also move away from the line, right? Which you can see it does. So you can see here that, for example, if we take this low, we can see that while price is going down on the dollar, it's coming up on the euro. So now they're squeezing towards the line, right? And then when the dollar starts to gain in value again, and obviously the euro then starts to fall in value, because they're inversely correlated, then as we expect, the prices move away from the white line. But what happens here? Look at our example here. The dollar is putting in a high, and the euro is putting in another low, which is exactly what we expect. But then the dollar puts in a higher high. So what do we expect of the euro? To put in a lower low, right? But look what happens. It doesn't put in a lower low, it puts in a higher low. And there is then our divergence. I hope that's clear. This one's moving away from the white line. This is the easiest way to think about it. It's made a higher high and another higher high. And this one should be moving away from the white line as well in the opposite direction. So it should be making a lower low and then another lower low. But it makes a higher low. There we have a divergence, and there we have tradable opportunities. And we do those trades exactly the same way as we would have done on the other examples we've used, using whatever concepts it is you want to use: change of state delivery, order blocks, inverse fair value gaps, whatever it is, anything, okay? Whatever you decide that your model is going to be, and we'll come to that in later videos. I'll help you to try and come up with some model ideas. But for now, you just use the concepts we used in this series, as we did in the previous examples, and that should get you a trade. So we've looked at some examples of where you could have used SMT to enhance your trade ideas or form part of your trade criteria that you look for before you start looking for an entry. And to me, that's exactly what SMT should be used for. It's a confluence to add when you have a trade idea forming and are looking for an extra tool to add further confirmation to your current idea. SMT is not the reason a reversal happens, and it isn't a reason to take a trade on its own, in my opinion, because if you take every SMT that you see as a trade, you're soon going to see that there are many, many fake ones, or ones that are too early and cause you to get stopped out. So it's important to use them alongside other concepts and let those other concepts tell you when to actually consider entering, like we've done in this video with the fair value gaps and order blocks and stuff. So another takeaway should be that we can use microstructure SMTs on a larger time frame to show us larger SMTs on a smaller time frame. So 2 1-hour wicks next to each other that have SMT will be an SMT on a smaller time frame, like the 5-minute, but that SMT will span a much bigger range of candles, of course. And when it comes to which asset to take when an SMT is present, for me, I don't worry about it too much, or at least I don't let the SMT tell me which one to take, because there's usually an equal case to take either one, because one probably swept liquidity while the other one failed to do so and therefore showed failure and weakness. Which of these is stronger or weaker? Well, you can either backtest and see if it makes a difference to your trading, or you could ignore it and just use other points of interest, market structure and so on to decide which one to take. In this, there's definitely some level of subjectivity, and often you'll find that it doesn't really matter anyway, as they both move together after the SMT anyway. And lastly, SMT can happen in a point of interest. In other words, one asset takes the point of interest and the other doesn't. So it doesn't have to be the highs or the lows that are showing the SMT. Remember my rules from the previous videos. What did it take? What did it break? You can think about this when you're looking at SMT too. So in my next video, I'm going to go over divergence between price and an indicator. I highly recommend checking that out too, as it's just as powerful as SMT in my opinion, and often easier to spot and more mechanical sometimes. And if you found this video valuable in any way, help me reach more people by subscribing, liking, commenting, all that stuff. It all helps and is very much appreciated. See you in the next video. Take care, guys. Thanks for watching.